Risk-on activities are back with a vengeance yesterday due to promising US-Iran peace deal resolution, where yesterday both sides has decided for a interim extension of their ceasefire to 60 days, despite the fact that US President Trump has not formally approved this interim ceasefire extension deal. However, US stock market choose to rally against on the backdrop of this optimistic news flow, where both the S&P 500 and the Nasdaq 100 surged to record closing all-time high yesterday, led by the usual suspect, which is the mega cap technology slash AI team play. The US dollar set back yesterday due to a pullback in longer term US Treasury yield, added by a weakening of oil prices that continue to retest close to their 6-week low. With a pullback in the longer term US Treasury yield, gold prices managed to stage a relief rebound, but still can't break above their 20-day moving average. Very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. So, as usual, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. So let's have a quick recap first of the events that has taken shape in the last 24 hours and as well as in early Asia session today. So with that, let me share my screen. Okay, so everything's good. Okay. Right, so this is the particular news flow, the important one that causes the very strong resurgence of risk-on behavior in the global market yesterday was this extension of the ceasefire agreement to a 60-day. All right, but however, it's still pending Trump sign off. So despite the fact that it's not yet confirmed, but market kind of choose to ignore this lack of clarity from the key stakeholder, which is US President Trump himself, and decided to actually go ahead and assume that the current situation between US and Iran are turning better. And we know that in the last few days, despite a lot of positive coming up from the US White House administration officials, the clarity of a peace deal resolution is not so clear in the near term. And US Vice President JD Vance, has kind of trumped up the optimism by saying that yes, US and Iran are going back and forth in a couple of language points, and also state that Iran appears to be negotiating in good faith with progress being made. So we know that this progress being made has been touted in the last few weeks, but until we start to get more clarity in from both stakeholders, they are still in the game of poker. So given that in the game of poker, we know that things could erratically turn not as desired at what market wants. And I do expect that this shorter term volatility will continue to prevail in the marketplace. All right. So we got to take things one step at a time and respect those very short term intraday levels. Okay, so with this kind of optimistic remarks that is being portrayed out by JD Vance, that actually reinforced yesterday's resurgence of risk-on appetite. So all the four major US stock indexes closed in the green yesterday, led by the Nasdaq 100 that rose to fresh all-time closing high, up by 0.84%, followed by the Russell 2000 up by 0.57%. And the laggard is the Dow Jones Industrial Average, closed almost unchanged, 0.05%, due to the fact that they are not heavily weighted by the leaders, which is the AI technology stocks that are leading the fort in yesterday risk on behavior yesterday. And the SPX also surged to a fresh all-time closing high yesterday, up by 0.6%. All right, over here. If you to look at the heat map of the S&P 500 very quickly. Okay, we start to see a sea of deep green in those technology slash AI related team play. All right, so we have the very strong rally in the semiconductor space within the technology sector, where Nvidia gained 0.8%, Broadcom gained more than 1%, 1.1%. AMD gained by a whopping close to 5%, and Qualcomm recovered up by 4%. And we have other software infrastructure related stocks like Microsoft gaining 3.5% over here. So net overall, it was a rally that is being led by the technology sector yesterday. All right, and with this so-called optimism that is being expressed by the U.S. Stock market, that also causes the U.S. Dollar to stage a setback yesterday. So yesterday, what we start to see is a very strong rally in risk sensitive currency like the Kiwi. So the Kiwi is the strongest performer so far against the major currency based on the 5-day rolling performance basis, where the Kiwi gaining the dollar by 1.6%, or put in a way that the dollar is losing against the Kiwi by 1.6%. That means the dollar is the weakest performer against the Kiwi. So if you look at the 1-day rolling performance, right now, what we could see is that in today's early Asia session, we start to see sideways flattish movement after yesterday's rally. And right now, the dollar is some kind of doing a bit of catch back up against the weakness that's being portrayed against the Kiwi, but still performing the weakest against the Kiwi right now as we are speaking. So the dollar is down against the Kiwi by negative 0.2%. So if you look at the US dollar index, it's still as flat as a pancake over here. So what I could see is that since 15th of May, so talking about 2 weeks back, it starts to be trapped within this tight sideways range between 99.51 and at the bottom, which is being supported by the 50-day moving average at 98.92. So net overall, still a rather directional movement in the FX market if you look at the current technical configuration or the technical juncture over here, being supported by the 50-day moving average 98.92 on the dollar index, but at the top side, it can't break above 99.51, indicating a near-term range resistance has started to be formed over here. And this 99.51 also correspond to this gap down that was seen from 7th of April and 9th of April previously. All right, that was this gap down resistance. Okay, so net overall, no clear movement in terms of the FX space. Neither we start to see a pronounced dollar strength or pronounced dollar weakness. Okay, so with that also one more particular news flow that is very important will be some key tier one Japanese data that was released out earlier in today's Asia session at around 8 a.m. Singapore time. So going back up over here, okay, so we do have a couple of tier one Japanese data that's being released, which is the Tokyo Core CPI data. So Tokyo Core CPI data tends to be a leading inflationary metrics in Japan ahead of the nationwide CPI data. So Tokyo Core CPI data for May came in below what market is expecting. So it came in at 1.3% year on year, below 1.5% that was printed in the previous month of April, and also what market is expecting at 1.5%. And the more important metrics, which is core CPI that exclude both food and energy. So Japan has a very interesting way of naming their CPI. So their core CPI is only exclude food. Core CPI exclude food and energy. That is much more being that is the preferred gauge that is being used to set monetary policy guidance and actual monetary policy by the Bank of Japan. So for the core CPI, Tokyo CPI that exclude both food and energy, also came in weaker than the previous month of 1.9%. So it came in at 1.6%. So if you look at the trend of the Tokyo core CPI, the growth has starts to inch down lower over here. So in fact, it was the lowest level, I think, since look at the 10-year trend. So it's the lowest level since July 2024. So that is something like a 2-year low in terms of growth. And with this latest rate of 1.6% year-on-year growth, that also breached below BOJ long-term desired inflation target of 2%. But however, positively, we start to see retail sales inching higher than what market is expecting. So retail sales came in at 2.1% year on year, way above what market is expecting at 1.3%, and so way above the previous March print of 1.4% over here. So what we could see over here is that it's a bit of mixed element in terms of the tier one Japanese data over here. So we look at the 10-year trend, it's the highest level. 2.1% is the highest level since April 2025. All right, so that's coming close to about what, a 1 year period of high so far. Okay, so net overall, what we could see over here is that the retail sales is recovering, all right, despite the fact that we start to see higher energy prices in the last 1-2 months due to the US-Iran conflict. And that actually gels well for the risk assets in Japan. Number one, retail sales are growing. That means services activities are still on the path of recovery. Earlier at the start of this year, where they got earlier at the start in no earlier about a month, 1.5 months ago, due to that Iran due to the negative feedback loop from that US Iran negative knock-on effects on the Japanese economy of higher oil prices. So that has been recovered due to the subsidy that is being we call it mini fiscal subsidy or fiscal spending that is being implemented by the current Japanese government. And with the Tokyo inflation rate that is doesn't go back up above the longer term inflation target of 2% that BOJ desired, that could actually hold back BOJ gradual interest rate hike policy for the month of June. All right, so earlier on, market is looking for a 25 basis point hike by BOJ to come in next month. But with the Tokyo CPI data, especially the core CPI data, ex food and energy, that is still hovering below that 2% target that BOJ desired. And in fact, the growth rate starts to decline to 1.6% versus 1.9% in the previous month of April. That was also a 1 year low. So with BOJ out of the picture of introducing their interest rate hike in June, that means the interest rate hike in June may not materialize. So and potentially it will be thrown down the calendar. And with improving retail sales data, that actually triggered on a risk-on behavior in the Japanese stock market today. Right, so that sum up the first segment of the daily dose. So let me now move on to the second segment, which is the selected cross asset classes for the intraday technical outlook. All right, so with that, let me expand my screen over here. All right, so let's start with the Nikkei 225. Right, so the Nikkei 225, still recall that yesterday we do have a bearish intraday outlook, looking for the price to do a setback, a minor setback. So the minor setback hit the first support zone at 63,788, 63,270 before staging a very vicious V-shaped rebound. All right, over here, and it didn't hit it didn't hit the second support level at 62,510, which is exactly the rising 20-day moving average. And given this very strong vicious V-shaped rebound over here, and with the technical hourly momentum indicator turning bullish right now with a series of higher low and hasn't hit the overbought level yet, we will now flip to back to a bullish bias on the Japan 225, indicating that corrective setback scenario from that previous all-time high that was seen on Wednesday all the way down to the yesterday's mid-Asia session is more or less over. And right now we are on the brink of a new bullish impulsive upmove sequence for the Japan 225. So using a 64,700 as my short-term pivotal support level in any dips over here. First intermediate support level will be the low that is being seen so far in today's early Asia session at around 65,500. If we start to see a breakout and an hourly close above 66,558, then I will tighten the short-term pivotal support from 64,700 up to 65,500. Next two resistance level to watch will be a bunch of Fibo extension cluster level at 64,046, followed by 67,046, pardon me, 67,047. I repeat again, 67,047, a bit of tongue twisting. 67,795 slash 68,154 over here. So this is also confirmed by a Fibo extension level as well. However, a price action don't stage that push up as intended and starts to do a bearish reversal back below 64,700. That would invalidate today's bullish bias and kickstart another choppy corrective decline to revisit 63,788, 63,270. Only breaking below 63,270 will trigger a deeper corrective pullback towards the next intermediate support level, retesting the 20-day moving average at confluencing at 62,510. So net flipping to a bullish bias on the Japan 225 for today due to the encouraging slash bullish momentum factor that has emerged again on the Japan 225 that is representing the Nikkei 225. Next up will be an update on the US Wall Street 30. So the US Wall Street 30 continues to trap sideways in our neutrality stance. Still can't break out above our upper neutrality limit. But however, the RSI is now showing signs of positive momentum that is building up on the hourly RSI as it continues to flag out a series of higher low after hitting the oversold region on Wednesday 3 a.m. Wednesday 3 a.m. Singapore time. So what we could see over here is that we'll continue to watch the upper limit of the neutrality zone at 50,800, breaking above 50,800, potentially seek out the start of a new bullish impulsive upmove sequence to revisit the 51,058, which is the current all-time high area, followed by 51,205, 51,320, which is the next resistance level defined by the 1.618 Fibo extension of from the minor swing low of 20th of May, 9 a.m. Singapore time. All right, so that's for the US Wall Street 30, turning slightly bullish over here, watching closely the upper limit of yesterday's neutrality zone, which is at 50,800 to trigger that bullish breakout, supported by encouraging bullish momentum build up as depicted by the series of higher low that is being formed on the hourly RSI. Next will be the SPX 500. So the SPX 500 yesterday cleared above our short-term pivotal resistance level. So we got to respect this positive price action and flip back to a bullish bias again. So two key support level to watch out today for today's bullish bias stance on the SPX 500 will be the breakout of yesterday's range resistance that was previously forming of a range top of 25th of May and 27th of May, now turns into an intermediate pullback support at 7,548. So using the pivotal support level of yesterday's Asia session low at 7,496. So that is also our downside trigger level in order to open up scope for that earlier anticipated corrective decline towards 7,455. But however, this doesn't materialize and price action touch and go, all right, over here. And this 7,496 also correspond to previously the gap up that is being seen at the start of this week, and also most importantly the lower limit of this medium-term ascending channel that I drew from the low of 2nd of April, indicating that the bullish structure still remains intact after yesterday's positive price action of 7,496. So hence I'll be using 7,496 as my short-term pivotal support, flip back to a bullish bias on the SPX 500. First resistance to watch will be a Fibo extension cluster level, 7,627, 7,632. Above it, followed by the psychological level of 7,700, also defined by a Fibo extension cluster level. Only a bearish breakdown below 7,496 that would invalidate today's bullish bias and kickstart that minor corrective decline sequence towards 7,455, maximum 7,393 that correspond to the rising 20-day moving average. Lastly will be the Nasdaq 100 over here. So the Nasdaq 100 tested our pivotal resistance yesterday at 30,318, 30,425 before doing a minor setback today. But however, the hourly RSI continues to be rather encouraging in terms of positive momentum as it continues to see a series of higher low above the 50 level mark and hasn't hit the overbought level yet. as we are speaking right now. So given evidence of a potential start of a bullish impulsive upmove sequence after yesterday we test at the downside trigger level. So yesterday we do have a downside trigger level at 29,700. It almost tested this 29,700, printed a low of 29,715 before shaping that positive reaction during before the start of the London session yesterday. So for sure, this is indeed a inflection level, 29,700 for the bulls to survive. All right. So using two key support level to watch. One will be at 30,000, close to 30,000 over here, which is the lower limit of this minor ascending channel drawn from the low of 19th of May, taking into account of yesterday's bullish inflection price behavior at the 29,700. So if we start to see a pierce up above 30,425 and hourly close above it, then I will tighten the pivotal support from 29,700 to 30,000. Next two key resistance level to watch will be a bunch of Fibo extension cluster level, 30,728, 30,795, which is also the upper limit of this minor ascending channel. Above it, seek out 31,050, which is the 0.764 Fibo extension, taking from this ongoing bullish impulsive upmove sequence on a minor time scale from the low of 19th of May. However, if price action don't pierce up as intended and starts to shape a bearish reversal below 29,700, that would invalidate today's bullish impulsive upmove sequence for the Nasdaq 100 and revive the minor corrective setback decline sequence against to expose 29,433, maximum 29,110, which correspond to the 20-day moving average. Lastly, will be an update of the two key commodities, starting with the oil, starting with gold XAU/USD. So gold yesterday, on Thursday, we do have a very tight pivotal resistance level at 4,456, and it did a squeeze up yesterday after doing a whipsaw around the 200-day moving average. Pardon me. So with this bearish divergence that has been formed, so right now realize that there's a bearish divergence. All right, lower high after hitting close to overbought level, whereas price action shape a similar high right now as we are speaking. All right, so the 20-day moving average is coming in at 4,580. So I will now use the 20-day moving average as the upper boundary, not convinced of a start of a new bullish impulsive upmove sequence. So using the 20-day moving average, that is so convincing with the range top that has been formed on 19th of May and 26th of May, 4,580. Yesterday's pivotal resistance will now be a critical pullback support level, 4,456. So flipping to a neutrality stand between 4,580 and 4,456. Only breaking below 4,456 will revive the bearish bias again on gold XAU/USD to revisit yesterday's low area at 4,368. Right over here, which is very close to the, so actually it's a zone. Let me put it a zone. The 20-day moving average, no, not 28, the key 200-day moving average. What I'm talking, all right, over here. So it's a zone between 4,394 slash 368. All right, this zone over here. All right, so flipping to a neutrality stand first, watching closely 4,580, 4,456, breaking below 4,456 will expose further weakness to revisit the swing low that is being formed yesterday, which confluence with the key 200-day moving average at 4,394, 4,368. Lastly will be the West Texas oil. So the West Texas oil yesterday rally was kept short, only printed a intraday high of 95.43 at 12 p.m. Singapore time before trading on a lower, softer tone due to that upbeat remark coming out from the US, stating that there's this interim ceasefire extension deal to 60 days, and while pending Trump's so-called formal approval, and with Vice President JD Vance optimistic remarks saying that peacefire, the current negotiation between US and Iran are getting more optimistic. But however, what's interesting that it can't break below the 6th of May 2026 low yet. So market participants are still pretty much cautious about the potential reopening of the Strait of Hormuz. So flipping to a neutrality stance today, 90.50 followed by 95.10 over here. However, a breakdown below 90.50 will expose further weakness towards 86.60, which is the 20th of April gap up over here, and as well as the 17th of April and 11th of March 2026 swing low that's confluencing over at 81.94 and 81.85. All right, so flipping to a neutrality stance first between 95.10 and 90.50. All right, so that sum up the intraday technical outlook setup on these various selected asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today's London European session? All right, let me go down the calendar. Okay, give me a minute. I think the calendar is hang. Okay, 1 second. Okay, good. The calendar is back. Okay, so at 1 p.m. Singapore time, we will have consumer confidence from Japan, another tier one Japanese data for the month of May. So market is expecting almost the change, almost the same figure level, 32 versus 32.2 that was printed in April. So this could, anything that is more than 32 could see a continuation of the positive feedback loop on the Nikkei 225. All right, so that will be at 1 p.m. Singapore time. And after that, at 2:45 p.m. Singapore time, we have France and Germany preliminary inflation data. So that could be very important as well, given that that could potentially drive ECB decision. And some ECB officials are sounding more hawkish, supporting a potential interest rate hike by ECB in June, which is next month, next monetary policy meeting. So at 2:45 p.m., France will release that inflation data. So market will be looking at the harmonized inflation rate year on year. So that will be considered as a core inflation rate, they call it. So for France, they are expecting it to jump higher to 2.9% from 2.5% year on year printed in the previous month of April. Then thereafter, we will have Germany harmonized inflation data out as well at 8 p.m. Singapore time, much later. So the harmonized inflation rate for Germany for the flash preliminary data flash figure for the month of May, market is expecting a slight pullback only to 2.8% year on year from previous April month of 2.9% year on year. All right, so then thereafter, those who have interest in dollar Canada or the CAD crosses, at 8:30 p.m. we have Q1 GDP growth rate coming out from Canada. All right, then thereafter will be a rather quiet US session, no key US data. Events to look out for will be two key Federal Reserve officials speaking, Fed Bowman and Fed Paulson at 9:10 p.m. and 9:15 p.m. Singapore time. So that pretty much wrap up today's Daily Dose of Market Insights. I'm Kelvin here signing off. So do have a restful weekend and also practice proper risk management, especially we know that intraday prices could get whipsaw here and there due to a change of tonality from both key stakeholder between the ongoing US-Iran/war conflict as both sides continues to play a game of poker. And as we know that Monday, there will be a public holiday in Singapore. So daily dose will only resume on Tuesday on the 2nd of June. All right. So do have a great long weekend break and we shall speak again on next Tuesday. Thank you.